I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back to Benzinga's Pre-Market Prep, brought to you by Charles Schwab. I'm your co-host, Joel Elconin, and I have Brendan Moynihan on the line. He's Managing Director of Market and Media Research at Marketfield Asset Management. He also has a few other roles. We'll let him explain those. Brendan, how you doing this morning?
I'm doing well, and yourself?
Doing good. So tell us about your other roles here besides being Director of Marketing and Media Research at Marketfield. A lot of markets in there.
Okay, I'm also an advisor to the editor-in-chief at Bloomberg News, a role that I had some years ago, and I've retained that when I made a job switch a few years ago. And then I also teach at Vanderbilt. I teach at the undergraduate school. I teach investment analysis there. And then at the graduate school, I teach at the executive MBA program, Global Macroeconomics.
Okay, we'll go into that a little bit later. But so you had some experience on Wall Street. Where did you work, and what did you do there? What did you trade?
Well, I started off trading bonds in the mid-1980s, and then I went to Chicago and traded commodities. And then I went back to trading bonds, and then I traded currencies, and then I quit. I went home.
Okay. And what made you leave that?
The 1997 Asian currency crisis. I was able to quit and go help raise my kids, and so at the end of that year, I just got out of the business and went home to help with the boys.
Okay, so it sounds like you had a good year, right? And were
Yes,
able to cash out the chips, and just you're one of the few people that like to take the money and run and do what's important to you then, right?
Yeah, exactly. The kids were a priority, and I had the opportunity, and I wanted to do that. So.
Okay, and you also had a role as a risk manager. What can you tell us what firm that was and what kind of oversight you had?
Yeah, the firm was gone. The firm was J.C. Bradford. It was an investment bank in Nashville, Tennessee. It was around from 1927 until April of 2000 when Payne Weber bought it, and then UBS turned around and bought Payne Weber about 3 months later. So the firm was absorbed into those other firms. But on the desk, on the bond trading desk, there were certain responsibilities that accompanied having a portfolio there. But then I was also on a committee with the partners to manage the partnership risk. So if the market took a turn, the firm was at risk, and we did a lot of risk management just at the partner level to protect the business.
Okay, so you didn't. So did you have to deal with like individual traders that were getting in trouble, or did you just have a mandate from the management committee that you oversaw the entire risk management?
Well, no, not the entire. So I had my segment of the desk, and it was the same thing when I was trading currencies. That there was an area that I was responsible for with the other traders in that capacity. So I basically studied the stuff in school, and I knew what I wanted to get into, and I did. And so in addition to trading, I had other responsibilities for management of the portfolio and other traders.
Okay, so you're involved in the education at Vanderbilt University. What classes do you teach?
I teach investment analysis, which is at the undergraduate school. We have about 80 students enrolled this time, split up into different sections, and it's basic, rudimentary financial statement analysis, taking a company apart over the whole semester. They have a mock portfolio online that they have to manage, make their investments throughout the semester, and then depending on their ranking, they get a grade how well or how poorly they did over the term. So it's just trying to introduce juniors and seniors into the investment analysis side of things, whether they want to get into that, at a CFO level, or whether they want to get into it as a stock analyst. It's a rudimentary class for them.
And so, boy, it talks about you really getting into some of the good old fundamentals. So they're looking at the financial statements of actual companies in the market, right? And need to review. Go
Right,
ahead.
so they're assigned, we assign them a company that they do an analysis over the course of the entire semester, and they have several papers they have to write. So they have to do a qualitative analysis of the company, and then by the end of the term, they have to have done a quantitative analysis of the company as well. So they have 12, 13 weeks, 14 weeks to do the work, and it's literally taking a company apart to kind of understand how it's done on an individual security basis.
What type? I mean, you mentioned they have to write several papers on different aspects of the company. What are some of the topics that they have to write on and analyze?
Well, it's a two-part. They do a qualitative in the first half of the semester, so they basically take the company and just non-number-wise do an analysis of the company, do a SWOT analysis, who are the competitors, what are the strengths and weaknesses and opportunities and threats to the company, and they do that at a non-numerical level. And then the second half of it, at the end of the term, for the second half of the term, they are doing the financial assumptions about how that company is going to do going forward, and then they come up with the projections to whether they think the stock is fairly valued, undervalued, or overvalued.
And what about technical analysis? Is that part of the course?
It's introduced to let them know that there is an industry out there that they will run across it. And it's not a heavy dose of it, but they are introduced to it, so it's part of their vocabulary, and they're aware of it. There are other places that have entire courses on that if that's something they're interested in doing, but at the academic level, we're really trying to do it at the fundamental side. So,
what do you think of technical analysis?
Well, I think that tactically, it affords useful tools for entry and exit. I think that it needs to be done in conjunction with a more strategic overview, which is more of a fundamental perspective. But it's basically a supply and demand equation too. If you're doing a fundamental analysis, you're doing what is the supply and demand for the company's products, right? And for technicals, I view it as you're basically looking at what is the supply and demand for the security itself, regardless of what people are doing, regardless of whether they are, because they're all anonymous, regardless of whether they are doing the fundamental analysis or not. So, it's one of the few markets that kind of runs a little bit contrary to economic theory in that, higher prices supposed to bring selling. Often higher prices brings buying, and lower prices supposed to bring buyers. Often lower prices bring selling. And to be aware that there is a cottage industry out there of people who are looking at certain technical indicators and certain technical levels, it can become a self-fulfilling prophecy. And I think that one is wise to at least be familiar with the basics of that approach, so that they're not caught blindsided.
Great answer. So, as part of your own investment analysis for your own portfolio, do you look at the charts? Do you have any techniques that you'd like to share with our listening audience?
Well, yeah. First of all, I want to do the disclaimer that with the mention of a portfolio, none of my employers endorse the books I write. I write the books for fun. I don't play golf or tennis, and so that's my hobby. But none of them endorse them or whatever, and so I just want to make sure that that's kind of off the table.
Okay.
For my own individual stuff, yeah, I do, and it's the same way. I'm going to do the fundamentals for the big picture, but then I'm going to use technical indicators to get a gauge of, is the market poised to run based on the self-fulfilling prophecies, or is it not ready to go yet? Am I buying into an overbought situation? I think that it is a useful mechanism, and so I employ it in my own personal stuff.
And what do you teach in the graduate school?
Global macroeconomics to the executive MBAs. So these are people 30 to 55 years old. They've been out in the real world. They have jobs. They're doing a 21-month course of alternate Saturdays, and I have them for a portion of the second year in alternate Saturdays. And we do global macro from 30,000 feet down, and we start with monetary policy and central banks and work our way all the way down into individual countries. I spend a bit of time on one of the days looking at the financial crises in the U.S. going back to 1792 to give them a sense that whatever legislation has come down the pike here in the last few years, it's not going to stop the next one from happening. It is a recurrent theme in capitalist economies, particularly where credit is involved. And if you didn't have credit, you wouldn't have a crisis. You just buy the thing that goes down in value, and that's it. Credit is the issue. And so I try to go through those crises and show the similarities and the differences over that entire time period. And rather than averaging them all together, I take into account that a larger number of them were taking place when we had a metallic money system in the United States. And then 100 years ago, when we introduced the Fed, suddenly we got an elastic currency, and the crises took on a different shape and a different nature. And there are different traits for those two big time periods. And then we look at them individually to see if there is any single kind of common thread to bring them together, and to realize that each one of them is different, has its own unique nuances. And if we knew exactly what it was, then we'd all be on an island somewhere, retired, and drinking little drinks with bamboo umbrellas in them and having a good time.
Let's talk about monetary policy, since you mentioned it a little bit. The Fed and their current stance, kind of pushing things down the road a little bit. Do you think that how much lower can interest rates go, and how long could they stay at these low levels? And what effect do you think that's going to have on the market if they start to take rates up a little bit?
Well, this is uncharted territory, 100 years after the Fed was created. The Fed used to manipulate or try to manipulate the business cycle with interest rates. Starting in December 2008, they basically abandoned that and opted instead for using the balance sheet, because they'd already taken interest rates down to zero, their interest rates. So they influenced the front end of the curve, and their comments and their moral suasion, their forward guidance is going to be instrumental in the market kind of, pushing rates in anticipation of the Fed moving. But there's, the countervailing forces are, you've got, some ructions in the market and some hot spots around the world that people are still sort of nervous about. And people have just gone through, a very horrendous stock market experience, at least, through 2009. And a lot of them have not, licked their wounds enough to be interested in equities. So, there's a sufficient number of people out there that are still scared, and they're probably going to, lead the Fed, is what my suspicion is. And it's not unusual. I'm not saying I have particular insight there that, rates will start backing up in anticipation. And actually, if you look at the front end of the curve, 2s and 5s are kind of bled up here to, 5 years got to 4-year highs the other day. So never mind the 10-year, but looking at where the Fed has greater influence with their policy at the 2-year level and then out to the 5-year, those levels have been creeping up. So, the market is starting to kind of think about, a higher rate environment, and it's probably not going to really come from the Fed changing Fed funds, because basically the Fed funds rate it used to be the rate at which banks lent to each other. Now it's the rate at which banks don't lend to each other. So, this is a new environment. It was an experiment on the way in using the balance sheet, which is now $4.2 trillion in size, up from $800 billion before the experiment started. And it's going to be an experiment on the way out. 18 months ago, Bernanke, who's now gone, but said they may never sell that portfolio. So how the central bank tries to engineer monetary policy with a $4.2 trillion balance sheet is a little more cumbersome than tweaking an overnight interest rate. If the Fed wants to raise rates and they start selling out of that portfolio, that's a little more of a sledgehammer rather than a little precision instrument using overnight interest rates at the bank level.
Okay, great answer there as well. So you've written a few books. Will you tell us about the books you've written?
Yeah. So, the book I think that brought me to your show is the book that I co-authored with a guy, and it's important that I mention that because the title will put you off. The title is "What I Learned Losing $1 Million," and he lost the money, not me. And I was just trying to make a fortune off of his misfortune. But I wrote the book 20 years ago, and he lost the money in the early 80s. He was on the executive committee at the board of governors at the Chicago Mercantile Exchange, and in 75 days he lost 1.6 million of the 1.2 million that he had. So in 1983, that was a pile of money. It may not be that much money now, but it was a pile of money back then. So I wound up 7, 8 years later, working for him for a while, and I'd had a theory about the mistakes that, I made and I thought other people were making, as traders and investors. It was basically the psychological aspect of it rather than any particular methodology for approaching the markets. My view is that there were as many ways to make it as there are people, and there are a few ways to lose it. And if you can master the law side, then you can let your methodology be as good or as bad as it is. So I married his story, which is hilarious, and was willing to bare his soul about the stupid things that he did, but it was too flowery to sell by itself. And then my stuff I thought was a little bit too dry and clinical to sell by itself. So I put the two together, and it's sort of a parable. And it was out there for years, and it got picked up. It actually got mentioned in a couple of other well-known books by an author, and that gave it a second life. And then a few years ago, Columbia University Press bought the book, and so they've republished it now, 19 years after publication. In the meantime, I've written a couple of other ones. The more recent ones were, I wrote a book in 2011 called Financial Origami, How the Wall Street Model Broke. And it's basically a look at Wall Street from 1971, when the firms were starting to go public. And all the changes took place on Wall Street that created a different incentive structure than had prevailed for the prior 200 years. And that was a long, slow train wreck leading up to the most recent financial crisis. I don't really cover the current one in detail. It's been written about extensively elsewhere, but I wanted to explain to people that this wasn't just something that happened 5 years before 2008. This happened for 35 years before then, and people had to understand the long walk up to what created this crisis if they were going to try to address what some of the problems were. And then I wrote a book last December, came out, called Next Time Will Be Different, and that is that class at school where I take the crises from 1792 until the most recent one, and do the walkthrough of them individually to try to identify, from a historical perspective, is there a common thread here that we can use.
And that first book, who did you co-author that with?
A guy by the name of Jim Paul, and he was in Chicago, and he was at the Merck from probably 77 to 83. But the day he lost all the money, they threw him off the exchange and threw him off the board. So that was the end of that part of his career.
Okay, because I started there 2 years later. That name's not real familiar. So before we let you go, Brendan, I mean, you teach students, you write books, you write a book about someone that lost $1 million. Any words of advice for investors or traders out there in this current market environment?
In the current environment, no. I mean, we're 6 years past the depths of things, and I just think that people have sort of ignored it. A lot of people have just not paid attention to the market, and now they're getting interested. And I don't know. I think they should be a little bit is backward looking, right? It's like asking me the question 6 years ago would have been a more useful exercise, but. And I don't really give advice. It's not my, not my charge. And I'm so heavily regulated in the fund industry that I have to be really careful. So.
Okay, all right. Didn't mean to put you on the spot there. It's just
it's all right.
You give us a lot of great background here and a lot of great answers to the previous questions. We've had Brendan Moynihan on the line. He's managing director of Market and Media Research at Marketfield Asset Management. He also teaches undergraduate and graduate classes at Vanderbilt University. Brendan, thanks for taking the time out to come on our show. We'd hope to have you on again.
Happy to be here. Thanks for the opportunity.